Alan Bond, one stock you like at the Jensen Quality Growth Fund is Becton Dickinson. The syringe maker really proved its point in 2015. Stock was up around 10%. Should you stick with it in 2016?
Yeah, well, at Jensen, we really are looking for high-quality companies. We define those companies as companies with competitive advantages, consistently high returns on capital, and robust free cash flow generation. We think Becton is a great example of that kind of stock. It's the world's leading producer of needles and syringes. We estimate global market share somewhere around 60%. We think that's a tremendous competitive advantage for Becton Dickinson, really from just the market share and the scale that produces. And it's a business that produces a lot of free cash flow. They can then take that free cash flow and invest it for growth. Growth vehicles for them are growing businesses in diagnostics and in life sciences, and then really just the expansion of their products throughout the world. That business model has resulted in very consistent results over time, high returns on equity, and lots of free cash, and that's what we like about Becton.
And you're also a fan of Accenture. This consultant's had a great year. It's up around 20%. Can they do it again in 2016?
Yeah, certainly. Accenture's had a great run, and we think the stock does have more room to run. They are one of the world's leading consulting companies, both for management and technology. What we really like about the business is their entrenched positions with really the vast majority of large global companies, and we think that gives them a tremendous barrier to entry, tremendous competitive advantage. We think they're very well positioned to take advantage of what we think is a very long-term secular trend, and that's businesses investing in technology to try to improve efficiency and improve profitability. We think Accenture is a great way to invest in that story from kind of a platform agnostic way, meaning that they can help companies regardless of what they choose, which path they choose to go down. Again, think growth opportunities for them continue to be very strong, and also a company that generates consistently high returns on capital.
Here's another global company that you like. That's UTX, United Technologies. That stock's down around 20% this year. There have been worries about its China business, and the strong dollar certainly is not helping with its international sales. Will that get better in 2016? Because the dollar may get stronger.
Yeah, absolutely. So United Technologies is a global industrial conglomerate with a wide range of businesses, all the way from elevators and escalators to aerospace component manufacturing. The real commonality we see in that business is high capital costs. We think that creates a real barrier to entry because of those high capital and high fixed costs. The business and the stock, as you mentioned, have come under some pressure this year. We think a lot of that is due to the emerging market slowdown that we've seen. But we think when you get beneath that, United Technologies is still a great business with competitive advantages, consistent free cash flow generator, and we think that for long-term investors, this pullback could be a great opportunity to own a great business at a good price.
And then finally, you are a fan of Procter Gamble. That stock has also struggled this year. It's down around 12%. They're even talking about selling off some brands. So are they going to be able to get their lineup right in the coming year?
Sure. Well, Procter Gamble, one of the most well-known companies in the world, really a global consumer products behemoth. We think, again, competitive advantage for them with brand strength and channel strength. We think that gives the business real resiliency. It's a business where they're trying to really focus and identify their businesses that are the fastest growing and the most profitable, invest in those businesses, and then shed the businesses that don't fit that definition. We think it's a great long-term strategy. We're supportive of it. And we think execution is largely going well, but there have been some hiccups for a variety of reasons. That's resulted in a little bit of a weak stock this year. This is another example where we think great business, still a very good underlying business, and in a stock that might be a bit on sale, and we think is a good opportunity.
All right, thanks for coming in and talking about those stocks. And thank you for watching The Street.